If history is any guide, it will be very challenging for the Federal Reserve to lift rates just enough to squash inflation while at the same time not sending the economy into a sharp slowdown. Markets will remain positioned as if a soft landing by the Fed is highly likely, which of course could prove completely wrong. Let's dive into these market dynamics with PGIM CEO David Hunt. David, always great to get some time with you here. You know, the market, as we just mentioned, is positioned for the likelihood we do get a soft landing from the Federal Reserve. But do you think, you agree with what Jim Bullard said this week, that thinking is just fantasy?
You know, it's really interesting as we look across markets broadly, and obviously PGIM, as one of the largest asset managers in the world, covers a lot of asset classes. If you look at the equities market, I would say that they are clearly at this point focused on a soft landing. They see very strong demand. They see good corporate earnings. They see profitability holding up well. And so the equity markets clearly have a kind of glass half full view of the economy at the moment. If I talk to my colleagues, though, in fixed income, it's quite a different story. They've obviously had rates rise pretty dramatically. They've had spreads gap out. And the possibility that the Fed does hike right through into a recession is very much now showing up in the forward curves. And then just to contrast that, if I go up and talk to our real estate colleagues, they're actually extremely bullish on this. I mean, first of all, they believe that obviously we've been underbuilding in this country for a decade. Prices continue to rise very nicely. Transaction volumes are very strong, and fundraising is good. And so real estate actually through an inflation cycle turns out to be generally a good investment. So they're much more positive on the through cycle view. So all three of these markets at this point are telling you different expectations. And the one thing you can expect is that will end in a lot more volatility for sure.
And David, we're seeing rates rise here in the U.S. We're also seeing a stronger U.S. dollar broadly. I'm just wondering what effects this could have on emerging markets. And let's just discount China for a second as its own story. But you have a rising dollar. You have the risk premium going up for a lot of these countries. Plus, you have geopolitical conflict that's going on. What's your assessment of the situation there?
So I'm really glad you raised that, because I think emerging markets as an asset class is finally starting to really unwind. I mean, for quite a number of years, it hasn't made any sense to invest in an index that has quite a bit of China, South Korea, and then Argentina all lumped together. And for many of our clients, what they're actually taking advantage of at the moment as risk premium has risen is to say, you know, we're going to create our own indices here, which separates out, for one, China, and for another, those economies which are much more susceptible to commodities, which are having a rather good run at the moment, and then others that we see as deeply troubled. And so I think this entire emerging markets construct is beginning to come apart, and I would say it's about time.
So, David, do you just stand clear of emerging market assets?
No, not at all. Actually, there's quite a lot of real opportunity. I think it's very important for people to understand that volatility in prices does not equate to investment risk. You know, you only lose money if you sell an asset for less than you paid for it or you permanently impair it. Because the market price goes up or down, generally that can mean that actually just the entry price is better. So as active managers, we actually benefit a great deal from this kind of volatility. And we're seeing some very good opportunities right now in emerging markets around the world as they've been penalized somewhat unequally.
David, want to get your take on alternative investments, especially as we see real estate. You mentioned before performing quite well. If you head over to your real estate desk, they like the current market. We also have commodities. They've been on a tear. Private credit. We have yields going up. Just in general, what does the alternative investment class or space look like right now?
So I'm really glad that you raised that, because it is one of the true growth engines of the investment landscape. And I think it's important to understand that this is driven by some very fundamental factors over the last decade. For the most part, actually, starting from the financial crisis, when banks were constrained by how much credit that they could put out. And the new capital charges for them means that the banks actually are not lending the way that they used to. They've really gotten out of a lot of project finance. They aren't doing the kinds of lending and leasing that they used to. And those markets are now being taken over by professional investors like us. And so absolutely, we're seeing the growth in private credit. We're also seeing broad-based new asset classes like infrastructure and renewables starting to come up. And I think this is all absolutely exciting for institutional investors and increasingly will be available to retail investors as well.
Indeed, good to hear. We'll leave it there. PGIM CEO David Hunt, always great to get some time with you. We'll talk to you soon.